So students, we are starting with Unit 3 for your paper MCM 205. Okay. So the name of this unit is Money Market, and as the name suggests, we will be studying all about money markets. What are the different institutions that you will find under money market? What are the different instruments you will find in the money market? Or what exactly is a money market and how it is different from the capital market? So capital market also is being simultaneously taught to you. So these are all very important part of our overall financial market. So let us start. So money market, basically the first distinct characteristics about money market, if you have to ask, is that money market is a market for short-term funds. All right. So when we say short-term funds, we don't exactly have a specific cutoff or criteria like that, but most popularly or most often when we say short-term funds, we imply that the maturity period of the fund will raise. It can, be up to a year maximum. It cannot be more than a year. So if it is more than a year, then this particular fund will come under a long-term fund and it will be a part of a capital market. So that means basically in money market, the type of instruments that we have can be very, very short-term. There are even overnight instruments that are having a maturity period of 1 day only. Okay, so it can work like that also. 15 days instrument, 1 week. So it can be anything, but not more than a year. The major players that we'll find in the money market are Reserve Bank of India, commercial banks, non-banking finance companies, state governments, large corporate houses, mutual funds. There are some more, and normally individuals are not active participants of the money market because the money market does not serve our interest, right? Because these are short-term funds. So normally individuals like us, we invest in the financial market to gain some return. Okay, so gain some profit. But money market is more like a market which serves the liquidity requirement. Okay, so they are more useful for institutions like banks, where they have to meet requirements like CRR, SLR from time to time, and to bridge that gap, they may have to go to the money market for a short-term period. Okay, so the money market and its instruments are usually traded over the counter and therefore cannot be done by standalone individual investors themselves. It has to be done through certified broker or a money market mutual fund. That is one thing. And another thing is that money market and its instruments usually have a very high denomination value, because of why individuals may not be interested too much in the money market. So the assets in the money market are actually very close substitutes for money. So that means that the instruments under money market are very, very liquid. Close substitutes for money means easily convertible to money. So the most liquid investments you will find in the money market. Okay, so I hope you would know the difference between a liquid instrument and a non-liquid instrument. There may be certain instruments in the capital market where the liquidity may be very, very low. That means you cannot easily convert this particular instruments into cash within a very short term. Okay, so you can take the example of a property that you have. Suppose you have bought a piece of land. Okay, now you're willing to sell the land because you're in immediate and urgent need of money. So in that case, you see, it is not always very easy, and it is not always very fast that you can sell off your land plus get the proceeds within a very short term. Okay, so finding a customer for your land, agreeing at a price, registration, and taking out a deed, property deed, sales deeds, and all of this is going to require some time. All right, so you may not receive the whole payment very easily or very fast. It may take some time. So money market is basically a market where low risk, unsecured and short-term debt instruments that are highly liquid are issued and actively traded every day. Okay, so you see money market instruments are normally having a low risk. Why the risk is low? Because it's a short-term instrument, right? So the more long-term a particular instrument is, the more is the risk associated with that particular instrument. Okay, so they are basically dealing with low risk, unsecured and short-term debt instruments. Unsecured at the same time and short-term debt instrument. Okay, so it has no physical, you cannot say that, you see, another characteristic of the money market is that there is there's not a physical place that you can see, okay, you will find, if you travel 3 more kilometers or 5 more kilometers in that direction, you will find the money market. It's not like a vegetable market or grocery market that you have. It's not a store as such. Okay, so you do not have a physical you can say boundary of a money market. All right, it has no physical location, but it is an activity conducted over telephone and through the internet basically. Okay, so it is there in existence, but it is not defined by any physical boundary. So it also enables the raising of short-term funds for meeting the temporary shortages of cash and obligations and the temporary deployment of excess funds for earning returns. The major participants in the market are, of course, the central bank of the country. All right, because see, the central bank of the country also controls the money market. The supply of money is being controlled by the RBI depending on situation. So depending on situation, the RBI, the Central Bank of India, will sometimes have to increase the flow of money and will sometimes need to decrease the flow of money. So all of this can be done by RBI through the money market. So other major participants of the money market can be a commercial bank, it can be non-banking finance companies, state governments, large corporate houses, and mutual funds also. So it refers to trading in very short-term debt instrument. That is what we have learned till now. At the wholesale level, it involves large volume trades between institutions and traders. At the retail level, it includes money market mutual funds bought by individual investors and money market accounts operated by bank consumers. In all of these cases, the money market is characterized by a high degree of safety and relatively low rate of returns. Okay, so this is another feature. The rate of return that you can earn from a money market is usually not as lucrative or as high as the capital market. Okay, because you see, in the capital market, it is possible to earn up to huge returns in your investment. But since money market investments are usually for a short term, and it is basically to meet your liquidity issues, to cap your cash shortages, so you normally do not earn a high rate of return on your money market instruments. Now let us talk about certain features of the money market instruments. Okay, what characterizes a money market and how it makes it different from other types of financial markets. So first of all, high liquidity, that is a given. So one of the key features of these financial assets is high liquidity offered by them. They generate fixed income for the investor, and short-term maturity makes them highly liquid. Owing to this characteristic, money market instruments are considered as close substitutes of money. So always remember, money market institutions are, popularly characterized to be a close substitute of money. Okay, or let me highlight that. So highly liquid means, the other name for highly liquid is close substitute of money, or it means that all the instruments that are being normally dealt with in the money market can be very easily converted to cash. Okay. Second, secure investment. These financial instruments are one of the most secure investment avenues available in the market. Since issuers of money market instruments have a high credit rating and the returns are fixed beforehand, the risk of losing your invested capital is minuscule. So first of all, you see, the money market instruments are characterized by high level of security. Why? because you have noticed, if you notice here, the participants of the money market, it is the Reserve Bank of India. I think the very stamp of being a central bank of a country do not require any more type of validity or authentication, right? Second is the commercial banks. So commercial banks are, of course, one of the major player or one of the biggest sector of the financial market. Okay, then non-banking finance companies, state government, large corporate houses. So mentioned, notice that they have used the word large corporate houses. Also mutual funds. Okay, so mutual funds, again, even in the capital markets, you can invest in the mutual fund. You have both capital market mutual funds and money market mutual fund. And one thing that you will, you can characterize mutual funds is that comparatively mutual funds may not give you a very high return, but they are comparatively safer compared to a lot of other types of investment. So some kind of stability you may find in case of mutual funds. So therefore, you see all of these parties, which are the major players of the money market, all of them are highly reputed organizations, okay, where the trust factor is very high. So this is why they have stated that the instruments which you will find on the money market are one of the most secure investment avenues available in the market. In contrast, if you see the capital market instruments, you will find that there are so many different types of participants of the capital market. You will find big corporate houses, you will find medium-sized corporate houses, you will find small corporate houses at the same time. So since issuer of money market instruments have a high credit rating and the returns are fixed beforehand, the risk of losing your invested capital is minuscule. All right. Then third is the fixed returns. Since money market instruments are offered as a discount to the face value, the amounts that the investors gets on maturity is decided in advance. This effectively helps individuals in choosing the instrument which would suit their need and investment horizon. Okay, so you see, in case of capital market, many a times you are not sure about the rate of return that you'll be having, right? So it is, if you have purchased shares of a company, you do not know how much return that you can get. Of course, you can get one kind of market average, but that may not always be valid, right? So it is quite uncertain. So in contrast, in case of money market instruments, normally what happens is that if all these money market instruments, they are offered at a discount to the face value, and when you the maturity is completed, you receive the entire face value of that particular instrument. So you see, in advance how much return you are going to get. So suppose the face value of a particular instrument is 100, hypothetically, you may get this particular instrument at 75 rupees. All right. And when the maturity, you will purchase this for 75 rupees. At maturity, you will get 100 rupees for each unit. So your profit will be 25 rupees per unit. Okay. So 1/4 is what you're getting as profit. So this you will know in advance. There is some kind of certainty, and the return is, you can say, fixed. It is kind of fixed, or it is kind of certain. Now we have learned there are many more features of money market, but these are the three distinct features or characteristics that makes it very different from other type of market. Now, what exactly is the purpose of a money market, or what exactly is the aim? Okay, what exactly is the objective? Why we even have a particular a topic called a money market? Okay, what is the need? Is there any need for a money market? Okay, so first of all, the very important point is the